United Breweries operates with a manufacturing scale that nearly triples the footprint of its closest competitor in the Indian market. The foundation is demographic. India adds up to 20 million people to the legal drinking age population annually, and half the market is under 35. Yet this consumer base remains untapped, with beer's consumption share sitting below 10%, a fraction of global markets. United Breweries captures the majority of this demand, holding a volume market share between 49% and 54% across its extensive brand portfolio. Favorable policy shifts in high-consumption states like Maharashtra and Karnataka are further easing distribution, removing historical barriers to volume expansion. This combination of market dominance and a long-term consumption runway should theoretically result in compounding profit growth for the industry leader. However, the Q4 FY26 earnings report challenged this outlook by revealing a sharp contraction in margins that the broader macro trend could not explain. Consumer demand was not the problem, as total volume actually grew by 4.1% year-over-year. Despite moving more physical product, net revenue for the company dropped by 3.1%. The severity of the disconnect is visible in the EBITDA margin trend, where overall earnings before interest, taxes, and depreciation contracted by 25.5%. During this final quarter, the EBITDA margin collapsed to 6.2%, marking a significant departure from previous performance levels. This contraction occurred even as the total Indian beer category expanded by 10% during the same 3-month period. When a company loses revenue while volume and market demand both increase, the failure is not with the consumer. It is a breakdown in the internal economics of the supply chain. The primary cause of this breakdown is contract brewing, a third-party manufacturing arrangement used when internal production can no longer keep pace with sales. During the fourth quarter, demand in high-growth states surged past the physical capacity of United Breweries' owned facilities. To maintain supply, the company was forced to route 20 to 25% of its total volume through these third-party breweries. Contract brewing carries structurally lower realizations and thinner margins than owned plants. Even as the company supplied more product to Maharashtra, this adverse mix heavily diluted gross margins, turning a 4% volume gain into a 3% drop in net sales. It demonstrates that market leadership becomes a financial burden if a company must sacrifice its own profitability just to physically supply its fastest-growing regions. This internal production bottleneck was compounded by a second layer of pressure: severe inflation in the cost of raw materials. Rising instability in West Asia has placed an immediate strain on global energy markets and supply chain reliability. Rising crude oil prices directly increased freight and logistics expenses required to move beer across the company's interstate distribution network. Simultaneously, gas inflation drove up the thermal energy costs for producing glass bottles. At the same time, a shock in global aluminum prices compressed margins on the can segment, which now represents 20% of the business. Management estimates these external factors will create a cost headwind between 4 and 5 billion rupees over the next 2 to 3 quarters. Following these projections, institutional analysts at Nuvama reduced their FY27 EBITDA estimates by 20.4%. To reclaim its margin, United Breweries has launched a strategy to internalize production and break the reliance on outside breweries. Capital expenditure accelerated to 4.32 billion rupees in FY26 to expand the proprietary manufacturing footprint. A major investment is a new greenfield brewery in Uttar Pradesh, serving the north, alongside new localized can lines in Telangana and Maharashtra to reduce interstate transfers. Civil work has already commenced, with these new facilities targeted to begin operations by the end of FY27. Expanding owned capacity is the only structural way to permanently eliminate the profit dilution caused by third-party contract manufacturing. While the manufacturing network is rebuilt, the company is using a second defense against inflation, shifting the product mix toward higher-value brands. This pivot to premiumization focuses on scaling labels like Heineken Silver and Kingfisher Ultra. The strategy is already showing results. In the fourth quarter, premium volumes grew by 16%, while mass market segments struggled. The financial motivation is clear. Premium products deliver double the percentage margin of economy brands. By replacing low-margin volume with high-margin premium growth, the company mathematically offsets a portion of the raw material inflation it faces. This shift structurally raises the company's baseline profitability, making the business more resilient to commodity price swings. We are now seeing an intersection between institutional fundamental research and technical market indicators. This chart shows historical price action and established support levels. The stock is currently trading near a historically validated support base that signaled significant entries in the past. Previous bounces from this channel have historically yielded cyclical returns of approximately 30%. This technical setup aligns with Nuvama's fundamental target price of 1,845 rupees. Both technical and fundamental analyses point toward the same projection, 30% upside from current levels. When chart-based support coincides with a documented fundamental recovery plan, it often signals an inflection point for institutional investors. The next 2 to 3 quarters will remain a difficult transition period as the company absorbs the 5 billion rupee commodity hit and manufacturing costs. However, FY27 is the targeted period where the company's capital investments finally convert into market power. Profitability will expand rapidly as localized capacity and premium revenue growth begin working together. The current margin squeeze reflects a deliberate trade-off: the cost of rebuilding the supply chain and scaling high-margin products to turn 54% market share into a more resilient profit engine.
For detailed TechnoFunda stock analysis every week, join our Telegram community and subscribe to the channel.